Hi students, the purpose of this video is to walk through activity 2, which we did in class, in a slower way so that hopefully you can go back to it and find it helpful as you go through activity 3. So for activity 2, just to set the stage, we've purchased a company. Our purchase price is $1.5 million. That's what we've paid. We did it by issuing shares. The book value of the company that we purchased is $1 million. And remember, the book value is always going to be the assets minus the liabilities. Or said differently, it's going to be equal to their GAAP stockholders' equity. So we paid $500,000 more than the book value of the company, and we're trying to decide what to assign that to. And the problem tells us that $200 of the $500 is undervalued PP&E. $175,000 is a patent that's not recorded on their financial statements. And anything that's left over we'll call goodwill. Notice over here to the right, we've also got the useful life in years of the PP&E, the useful life of the patent, and then we've got how much we'll need to depreciate or amortize it per year. So I will ignore the year one information for now and just do the prompt one, which is outlining the purchase entries. As a reminder, these purchase entries happen on the parent company only. So what the parent company is doing when they purchase this company is they're finding a way to get the company's standalone financial statements into their general ledger on a standalone basis, and then they're updating their own financial statements on a standalone basis. So they will debit equity investment for the amount they paid, which is the $1,500,000. And they're going to credit their form of payment, which in this case was a combination of common stock, which we record at par, and we balance the entry to APIC as no cash was paid. So that common stock, they issued 50,000 shares at $1 par. So we've got 50,000 in common stock, and I'm balancing the entry with additional paid in capital. So now I've got the purchase recorded. I've got some other things that I need to do as the year goes on. And this is what we'll do in activity 3 as well, because in activity 3, you're going to go to the second year. The first thing we're going to do at the end of the year is we're going to record our subsidiaries' earnings. So we're going to debit the equity investment account again to increase it for the earnings. And we're doing that because we own them 100%. I'm recording 100% of the earnings. And I'm going to record equity income for the same amount. Next, I need to record the fact that they've paid me a dividend. So I'm going to debit the cash and credit the dividend account. And as a reminder, the dividend account is a contra stockholders equity account. So it's reducing the stockholders equity. Sorry, I put credit dividend. It's reducing the stockholders equity of the subsidiary, and therefore we're reducing our investment in that subsidiary. And that dividend received was $31,500. Got one more thing we have to do here, which is we need to go ahead on our financial statements, our being the parents, depreciate and amortize that PP&E and that patent. So notice I'm debiting equity income, which seems so odd because normally when we depreciate something, we depreciate it using depreciation or amortization accounts. Well, we'll do that in consolidation. For now, we're just going to debit an income account to reflect the fact that we've got $10,000 less earnings associated with this subsidiary than we had before because we are depreciating part of that value. Now, you might say too, why are we crediting the equity investment account? Remember that initial undervalued PP&E is sitting in this $1.5 million. So we are slowly making that amount smaller by depreciating it in that equity investment account. So I'm going to do that for the PP&E, and I'm going to do it for the patent. So again, same accounts, debit equity income, credit equity investment. All right, now I'm going to pause because remember, the key to consolidation is having a roadmap. And your roadmap is going to be this equity investment reconciliation. So I need to understand all the components. So at purchase, we said that the subsidiary had a GAAP book value of $1 million. So I'm going to put that in my first line. We also assigned $200,000 to the undervalued PP&E, 175 to the patent, 175, and the remaining we assigned to goodwill. Notice then that my total recorded at purchase, this 1.5 million, matches the 1.5 million I recorded above. I'm going to increase anything that happens on my subsidiaries GAAP equity, I'm going to use in column B. So I know that when they have income, that increased my investment, it increased their equity. And when they pay a dividend, it decreased my investment and decreased their equity. So all things being equal, their total GAAP equity should be $1,178,500 right now. And we'll check that in a minute. But we still need to go ahead and record those depreciation entries into our reconciliation that we put above. So now I understand that of the balance that I have on my parent company general ledger, the $1,651,000, I understand the components that are associated with the subsidiary and the components that are associated with other items. And that's going to be our map that we're going to use when we get to consolidation. So what do we need to do for consolidation entries? Well, let's start and just remove the investment and the equity of the sub. So we're going to start with their common stock, and you might say, well, where did you get that? Well, I can go down here to the subsidiaries financial statements, and I've got the 100,000, 125, and 953. Notice again that number we thought we'd find, 1,178,500 in GAAP equity, and we know we have 1,178,500 in GAAP equity sitting here. So we'll decrease the common stock. In consolidation, again, these are entries we're not doing on the parent or the subsidiary. We're doing them in the ether, so kind of in that no man's land inside of the general ledger. And I'm going to go ahead and notice this. I'm going to put in $210,000 into the equity investment income. I'm going to come back to that, but just use that as a placeholder right now. And I'm going to do the beginning of the year subsidiaries retained earnings. The subsidiaries retained earnings is the sum right now of their current year income of $210 and their prior year retained earnings balance of $775. That totals to $985,000, which, plus the dividend, which if we go down to the bottom, we see in their retained earnings. So if I take, and I'm just going to color code these for a second slightly differently so you can see it. The $775, the equity income, less that dividend of $31,500 equals their total retained earnings. But I'm doing it in the parts because the current year items actually are flowing through into the financial statements differently. And then I will decrease the equity investment for the $1,178,500. These are populated for me just because I had it in my reconciliation above, but let's do a double check. I'm going to move out of the equity investment all of the items associated with undervalued PP&E, patent, and goodwill. Where did those amounts come from? They came from, and I'll put them in green up here, they came from my reconciliation. So 190 for the PP&E, 157,500 for the patent, and 125 for the goodwill. And notice I'm using the end of year amounts here. That deviates from the book. This is where I think the book is a little confusing. So I like to use the end of year amounts here so that I can keep that equity investment income account nice and clean when I'm doing consolidation. The last thing I'm going to do is I'm going to reclassify in the consolidation money out of the equity investment income account, because remember I had put a debit into equity investment income for the two amortizations and depreciations, the $27,500, and I'm going to move that out of where I'd placed it and into amortization depreciation. So let's go down and look and see what this looks like actually in our grid. As a reminder, when we start, this is the parent company at the end of the year, so it includes all of their purchase entries, including their current year earnings. And notice on the income statement, it's got equity income of $182,500. Those are the entries we made above. So where did we make them? Well, we did $210,000 in income. I'll just do a little sheet for you right here. We did amortization and depreciation of our PP&E and our patent of $27,500. Remember, that was negative. And the difference between those two, the $182,500, is equal to what you see on the financial statements. So I want you to always step back and say, what do I know for sure has to be true before I even start the consolidation? And I know some of this is already populated. I know I need to get the equity investment account to zero. I know I need to get the equity income account to zero. And I need the consolidated equity accounts to equal that of the parent. So let's plug in each of our consolidation entries. I'm going to start with entry A. So we've taken $1,178,000 out of the equity investment. We go down and we're going to take the $100,000 out of common stock. We're going to take the additional paid in capital, $125,000. And notice our journal entry was only for $775,000. Debit to retained earnings. And it also included a credit when we did our consolidation entry to dividends, which is inside retained earnings. That still doesn't equal the 6260 right here. It doesn't equal the retained earnings of the parent. Why is that? Because as we're entering the entries for A, we need to go to the income statement as well and do an entry for that equity income to come off the financial statements, as well as that reclassification out of equity income and over to depreciation expense. When we have entries on that consolidation into net income, remember net income, anything that happens here automatically happens to retained earnings on the balance sheet as well. So if I simply plug in the impact of that entry, now my retained earnings, in fact, does equal the parent company's. So I took out the beginning of the year balances, the current dividend, and then I know that retained earnings will get updated for the fact that I'm removing the $210,000 as well as the different components. All right, what else do we need to do? If we only had A done so far, we wouldn't see our equity investment going to zero yet. So we've got to go to zero. I'm going to take out that $472,500, and where does it go? Again, we did this in the journal entry, but I can also use my map of my reconciliation, and I know I need to take that $472 and spread it to the PP&E, the patent, and the goodwill. Now, at this point, our consolidation should be complete. Let's step back and make sure we think all of our components make sense. Does the net income on the parent equal the net income on the financial statements of the consolidated company? And the answer is yes. Why is that important? Because this $182,500, right, is a combination of the $210,000 minus the depreciation and amortization. Do we have equity equal to that of the parent? We do. So we know we've done that right. Is equity income zero? Yes, we've taken all of that out. And is our equity investment zero? Yes. So that's the way you can step back and check yourself. I know the hardest part about this, and we can talk more about it in class, is thinking about those downstream impacts of the retained earnings. But if you'll follow each of the steps and use that reconciliation as your guide, I think that as you go to year 2, you're going to find that it's going to make more sense.